On economic news this week, we saw the average weighted prime lending rate fall by a further 26 basis points to 11.87%, while the Treasury bill and Treasury bond rates were almost stable during the week. At present, the one-year Treasury bill rates remain at 12.9%, while the 3-month rates are hovering around the 14.5 mark. We feel that as and when the government increases its long-term borrowings, we feel that the 3-month Treasury bill rates could start falling down even further. From an inflation perspective, we feel that the month of January could see a significant surge in terms of inflation, not only due to the VAT impact, but also due to the adverse weather conditions which are continuing into January. As a result, we feel that inflation could be in the high 6 to 7% levels for the month of January, and until adverse weather conditions adjust downwards, this trend could continue into the month of February and March as well. However, we feel that the electricity tariff reduction could range between 5 to 10% in the coming month. Overall, in terms of economic activity, we saw the month of December seeing a significant pickup in terms of retail activity, but going into January with the impact of VAT coming into place and inflation, we are seeing a slowdown in terms of consumption for the month of January. Also, from a currency perspective, Sri Lanka also reported foreign reserves at $4.4 billion at the end of December, and this was driven by mainly the $750 million coming in from the multilateral agencies such as IMF, ADB and World Bank, and also the improvement in current account which has been facilitated by improved tourism and worker remittances reported during the last quarter of 2023. Worker remittances reported a high of $537 million, which is one of the record levels for the month of 2023. Since the currency has been on an appreciation spree over the last 2-3 weeks, we feel that if the current trend kind of continues with Sri Lanka having a current account surplus, the government could consider relaxing some part of the vehicle imports, and there have been talks about relaxing import relaxations on smaller vehicles if the current account is showing positive results going into second quarter of next year. From a commodities perspective, we've seen crude oil being quite volatile during the first 2 weeks of January, and this has been particularly because of the geopolitical tensions in the Gaza Strip as well as the Red Sea having an impact on crude oil prices. However, the US continues to have a surplus in terms of its oil inventory, which has kind of mitigated the impact of the geopolitical tensions. As a result, over the last 2 weeks, we haven't overall seen too much of an increase in terms of oil prices as such.